Hello, this is Brian Resney, President of Resney Wealth Management, bringing you an important update about the economy and the investment markets. Well, it's officially here. We've got a correction right now in the overall equity markets for 2018. So essentially, the gains that we saw in January were basically erased in the first couple days of February. This is fairly normal. In fact, we have 5 and 10% corrections often a couple times every single year. And not just in the equity market. The bond market, by the way, is negative year to date. I look at treasuries, 30-year treasuries, they're actually negative year to date around 5%, meaning they're actually underperforming the equity market. All assets will fluctuate over time. The big key is this a temporary pullback till we go to maybe higher potential ground over the next 6 to 12 months, or is this the big bad recession? We do not see signs of recession. In fact, all the indicators we see are on an even uptrend. Remember, we had a slow growth economy the last 10 years. The economy under our new president with fiscal discipline, with tax reform, with rules and regulations being cut back to meaningful rules and regulations, we're starting to see a little bit better growth in the U.S. economy and actually around the world. But you're going to get these pullbacks. I often am asked by a few clients, Brian, are you going to do anything different? No. We're going to basically manage the money properly. If we need to make adjustments to the portfolio based upon our strategy, we certainly will. But we're not going to knee-jerk reaction. We're not going to basically sell something just to sell it. Emotions are going to get you into trouble. As I've expressed to every client, my TV and radio show listeners alike, normal pullbacks in the equity market, the bond market, real estate are natural occurrences, 5-10% corrections a couple times every single year. We really had no meaningful correction last year, but if you remember the year before that, we were down better than 11 or 12% in the month of January in 2016, only to end the year up around 10 to 12% on the positive side. So remember, folks, these things happen. And I will say it's nice to hear from a few clients who actually give us a pat on the back and said, Brian, you were right about a correction. We're not nervous because we know you're going to do the right things with our money. We stress to every client, don't be nervous either. As long as you have a risk management strategy for major risks like a recession, which again we're not seeing signs of, we're seeing a nice even growth economy and it's getting slightly better, you're going to see volatility all the time. Nothing goes straight up, nothing goes straight down. This volatility, in my opinion, is warranted. I expected it, and I also warned clients about this. Almost every single update we have expected. So we've had that pullback. What's interesting, folks, is the bond market. The bond market is going into negative territory. In fact, the 30-year treasury is negative about 5% year to date. So bonds, I thought bonds were safe, people say to me. Bonds can be as volatile and risky as the stock market from time to time. Remember that. I'm glad to say that the types of bonds that we own in our more conservative accounts, in our opinion, are the right bonds to be in. We continue to own floating rate securities and emerging market debt, which in my opinion are two areas that show opportunity going through 2018. Of course, if you're a client, you have any concerns, give us a call at the office or send me an email. Love to chat with you a little bit. And as always, remember, market volatility is normal. And you're not a 3-month or 3-day investor. If you're 70 years old, you and your wife, one of you is going to be around till you're in your 90s. Volatility is going to be your friend. It's been around here forever. It's not going away anytime soon. I'm going to include a couple charts just to show you some graphics of inter-year volatility year to year, which happens every year. And you'll see how over a rolling 3 and 5 year time frame, which is how you, the investor, should be looking at your account, actually investors benefit from that short-term volatility. Again, if you're becoming emotional and maybe the wheels are falling off the cart in your opinion, give us a call. But if you're a smart investor, you listen to my updates, you stay calm, and don't look at your account every day. If you're one of those investors that are looking at your account every day, 3 times a day, you're looking at it too much. Let us do our job. If you're looking at your account value more than once a month, that's more than enough, in my opinion. If you're managing your own money, then sure, look at it 20 times a day. But let us do our job. Take the pressure off yourself. Stop looking at your account. It's only going to upset you on the short term when you're a long-term investor. As always, we appreciate your business and trust, and we appreciate your referrals. So if you've got friends and family members who need a good financial money manager, please refer us. We always appreciate those referrals and, of course, your business. Have a safe and profitable day.